This conference will now be recorded.
Okay, so let's start off talking about. So over here we are talking about the Basel model development. Basel model development, the probability of default model, PD, the EAD, and LGD, LGD models using segmentation. Now, when I say using segmentation, I'll be talking about three types of segments that is generally created. So the model development is or the models are being developed for the broad segment is the retail exposure. So we are actually developing it, or the model is being developed for the retail exposures. And within the retail exposure, the sub segment over here will be the qualifying revolving retail exposures or the QRREC. So this is the retail exposure. A retail exposure, and the sub segment is the sub segment that we talk about over here is the QRRE or the qualifying revolving retail exposures. The QRRE. Now, the first question that I would ask in participants over here is that how many groups or in how many broad segments does Basel divide the portfolio of a bank in? So how many exposures does Basel divide the segment a bank's books? So we did it when we started of Basel. That was so we did this part right at the beginning. So in how many portions or into how many groups or into how many parts does Basel divide a bank's book into?
In my retail portfolio only, right? You're talking about retail portfolio.
No, I'm asking. So my question is, I'll just rephrase my question. The bank divides the entire. I mean, Basel divides the bank's entire books into five groups of into five segments. Right. What are they? Sorry, I gave
Yeah,
out the answer unconsciously. So my
yeah.
question was into how many groups or into how many segments does Basel divides a bank's book into? So Basel divides a bank's book into five broad segments. They are: number one is a corporate exposure, number two is a sovereign exposure, number three is a banking exposure, number four is a retail exposure, and number five is equity
Top.
exposure.
Yeah.
So these are the five basic groups or the five basic exposures into which Basel divides a banking book into, right? Now, within each of these separate subgroups are created, but these are the five basic groups. And out of them, the retail exposure is the fourth exposure, right? So it says that a bank broadly has five different kinds of exposures, which differs in terms of their risks. One is number one is the corporate exposure. The corporate exposure is kind of comprises of both your SME as well as your corporate, right? So that's a commercial exposure. The second is a sovereign exposure. The third is your banking exposure. The fourth is your retail exposure, and the fifth is your equity exposure. So mostly we are kind of concerned with with the two exposures, the corporate, the commercial exposure, and the retail exposure. So we are kind of concerned with these two groups, right? So now again, the the commercial exposure is divided into two groups or uh, two types of firms. So one of them is the SME and the other is the corporate. So what is the cutoff for identifying a firm as an SME that Basel prescribes? So within the commercial exposure, Basel defines a firm as an SME if the condition holds. What is that condition?
Ticket size less than 50 lakhs, something like
Right. Prabhu is correct. If it is more than 50 million euros. So greater than equal to 50 million euros is corporate, less than 50 million euros is right, and less than 50 million euros is your SME, right? Now these two types of firms are supposed to have or now these are two types of firms that fall within, or the two five type of obligors that would fall within this description of the commercial funds. Now, the corporate or the commercial exposure is divided into how many subparts? So, how many subparts are there or sub exposures are there to the commercial exposure? So, according to Basel, the commercial exposure can be divided into some groups of sub exposures, right? How many are there? Guys, this is basic puzzle, so you have to know these just at the at the click of your finger. So these are very basic questions which they ask. They would ask you to kind of assess your understanding of the regulation. So they may not ask you the definition of each of these sub exposures, right, until and unless it's a very specific commercial portfolio requirement. But at a high level, they'll ask you these questions. So how many sub exposures are there?
Special lending and SME.
No,
The
Retail.
commercial
SME and
basically,
corporates are the two types of funds under the corporate exposures, right? They're the funds, they're the obligors. Now, what are the types of exposures? There are again 5 types of exposures which falls under the corporates or under the commercial exposure. They are, the 5 subclasses are: number one is project finance, the second is object finance, the third is income producing real estate, the next is high volatility commercial real estate, and finally it's commodity finance. So these are the 5 sub exposures which falls under the commercial exposure. Under commercial exposure, these are the 5 which falls. And under retail, we all know, so there are 3 sub exposures. One is the QRRE, which stands for qualifying revolving retail exposure. The second is your mortgage. The third is other retail.
Tanmay, but the 5 subclasses you told, the project finance, object finance, commodity finance, these are the SL categories, right? The special lending categories in the commercial portfolio. And
Yeah, so
I mean,
these are the 5 broad exposures under which the entire commercial lending is done, or commercial lendings are classified.
even the SME is a part of all these 5. Is one of, I mean, SME
Yeah,
also belong.
SMEs are also into any one of these activities as well. So any commercial lending, if you think about it, will fall under each of these 5. So for example, let's say I'm talking about let's say object finance, right? Now, what is an object finance? In an object finance, you are actually financing an object, right? So what is that object? That object can be a vehicle. That object can be some machineries or something. Now that object must be such that that object itself generates a cash flow, and the loan that you are being given is being backed by that cash flow. So let's say I'm thinking about a vehicle finance. Right now, who all can take vehicle finances? It can be a small, medium scale firm who is just starting on with truck business or fleet business can take the loan, right? So they are a part of the obligor. So obviously, then object finance becomes applicable to this. Let's say there is a small firm. Let's say, uh, let's say suppose I want to start my own company, right? So what I do is I take a franchisee of Domino's. Now I am given the definition. I am a small, medium scale enterprise. I am a small proprietorship firm, and I want to take the franchisee of Domino's. Now, what is Domino's then? So Domino's is franchisee. So that's a franchisee finance. So what's a franchisee finance? The franchisee finance is nothing but it falls broadly under project finance. So the from that project, from that franchisee, whatever revenue will be generated, right? So or expected revenue will be generated. So from there, the loan will be backed against the cash flow from that. So it's a broadly a part of that. Now SMEs and corporates are the type of obligors that will fall, because in retail you don't make any such differences, but that difference comes into when it comes to a commercial portfolio. For example, a diagnostic firm, right? So what would a diagnostic firm do? A diagnostic firm would say buy like X-ray machines, weight machines, or any other specialized medical instruments, right? Now, when the diagnostic firms are borrowing, they are kind of, so each of these machines are being kind of contracted, or they are being given on the basis that these will generate certain revenues and they will be paying back. Now, not all diagnostic firms have a revenue as large as $50 million, right? So not all are very huge path labs. So there are small and medium scale path labs as well. So in such a case, this will become so this becomes an issue, right? So in a way it fits into that. So whether it is a SME or whether it's a corporate, anyone can fall under any of these. Just that the scale of lending will be different. But broadly, the lending exposures. So the lending which creates the exposures, whatever lending you are doing will fall in either any one of these five categories. Say for commodity finance also, right? So the exposures would relate to the loans that are being made, right? So that and so that's why it will fall under for so it is applicable both to a corporate as well as to an SME. Krishna, uh, that clarifies your doubt. Any other questions on this?
Yeah, Tanmesh.
Perfect. Perfect. Okay. Hmm. Fine. So let's kind of move back to the retail part. So I just asked you these questions because these are some parts where they tend to ask you, but they would not kind of delve deeper into the definitions. Then they are not going to ask you questions like what is the difference between a project finance and an object finance and so on. That is something that they are not going to ask you, but it is expected that you have some basic idea about these things. Okay. Guys, there is a new. Perfect. So let's kind of move on. Okay. So no, so while we were talking about okay. So as we talk about, so as I was saying, right? So we were talking about the developing the PDLGD EAD models using a segmentation framework. The product was a retail exposure, and the subsegment was QRRE. Now, when I talk about QRRE, so basically this is the qualifying revolving retail exposure, and the product that I'm going to talk about is credit cards. Now, credit cards is something that we all use, and we all know very well that how is this card or how this card is actually used, and how is it that this card is kind of so how is it that this card is used and how this card operates and how this card works. So this is what is credit cards. So we will focus first of all while we start our discussions, right? So we will start off by talking about what and how credit cards look like and how is it that they operate, how is it that they work. So so basically, while I talk about credit cards, two things obviously come back to my mind. And it is very important, that we understand this particular product, because most of the opportunities which is generated around retail risk is around credit cards, because this is something that banks are really passionate about. And there are reasons as to why they would be passionate about that, right? So what are the reasons? So first of all, so think about credit card. Now, credit cards, the first thing is that they are unsecured, so you need not to like take any you did not put any collateral while you are buying it, and this product is revolving. Therefore, there is no fixed term to this particular product. So first of all, credit card is an unsecured lending. It's an unsecured lending, and there is no time. So there is no kind of terminal time or term associated with this, right? So there is no fixed term to the product. There is no fixed term. Now it is not secured, as well as it does not have any fixed term. Now given this, it clearly states, now given these two things, it clearly states that this is going to be one of the most risky lending products. So therefore, this is the most risky lending product. Risky lending product. Most risky lending product. Now, given that it is the most risky lending product, therefore, one thing is very so there are a few things that we can make out, or we can identify about, or intuitively we can think about the credit cards. The first is, it has the highest APR. So it has the highest APR. It has the highest APR, that is the annual percentage rate, or the rate of annual percent rate of interest. It has the highest APR, and the second that we have over here is, so it has the highest APR, and the second thing that we come across over here is, has the greatest chances of default. Has the greatest chance of default. Why? First of all, people always has the option to use the credit and not pay it back. The greatest chances of default. So obviously, people would use the credit and they would not want to pay it back, because it's a revolving credit. But after a point of time, when the limit comes up to an end, they do is they pay it back, and then again they start using it, right? So obviously there is this particular chance. Now the next question that comes out over here is that you have the greatest chances of default. Now, not only this, but among a set of other retail products, it also ranks among the top most. It has the highest chances of default because it is unsecured and there is no fixed term, and hence it has the highest APR. As a result, this is the most expensive loan that a bank can give out. This is as well as the most expensive loan. It has the most, it is one of the most expensive loans that the bank can give out. So now, one of the most, so basically to assess, so therefore, this exposure, this QRRE exposure is something that we need to really understand. That why is what exposure is this? What are the key sources of risk of this exposure, and how is it that I can model this exposure, and how much of an optimal capital should I keep against this exposure? So this is something that we want to understand. So over here, so likewise as we have said, so let's try to assess what are the key sources of risk against this particular product, right? So over here, as we kind of get to see, right? So as you kind of get to see, so some of the important things. So let's try to assess credit card as a product. Let's try to see what are the sources of revenues and what are the sources of cost that this product has, and where exactly does this the risk of this product lies. What are the type of income that the bank can generate from this particular product? So we are trying to, so we will be trying to assess it not from a profitability aspect. That is something what the marketing analytics guys would be doing. Our objective would be to assess it from the risk perspective, from the perspective of exactly how the product is created, exactly how the product is developed, and how the product is something that we could kind of work upon. So this is something that we need to talk about. Now, as we talk about credit cards again, right, credit cards as a product has two very important features, or has two very important components into it. The first and the most, so one of the most important part that we have over here is the limit of the card. We have the limit of the card. The second and the most important thing that we have over here is the balance on the card. Now, each of these are very basic, yet they are very important components. Why? Because they will help us capture the different sides of the riskiness, or the different aspects of riskiness of the borrowers, of the applicants. Right? Okay. So over here, let's say I'm talking about the limit. So what is the limit? Limit is the permissible amount of credit. the permissible amount of credit. Permissible amount of credit. And the balance that we have over here is, so basically when I talk about the balance, so what is balance? The balance is that part, the balance is that part of the limit which has been used. So this is the part of the limit which has been used. Of the limit used. The part of the limit which has been used. So what is it that we are trying to do over here? What we are trying to do over here is we are trying to define the key characteristics of, or the key components which explain, which can help us explain the riskiness of the product. So we talked about the limit and the balance. Now over here, if you have a look, you will see that using this limit and the balance, you can create two indicators. One is the headroom. One is the headroom. The other is the utilization. The other is the utilization. So what is the headroom? Headroom is nothing but the limit minus the balance. Utilization is limit by the, sorry, balance by the limit. By the limit, and if you want to convert it into full percentages, it is 100. Right. Now the question is, what, why are these two the risk, or why am I saying that these are important identifications of the riskiness of the borrower? Now what do these two, what are the things that these would kind of try to hint at? The first thing that it would try to hint at is the following. Let's say the headroom is low. If the headroom is low, what does that mean? It means that the person who has almost used the has almost used it up to the limit, and hence he is of a high risk person. So he has almost used his uh, balances the entire limit, and hence he is someone who is high risk. Let's say the headroom is high, that means this person is of a low credit appetite, of a low credit appetite. And from the view of RWA view, so this guy is not really a very risky person. So what he does is he's not used the entire amount of, but these people can possibly be defaulters in the sense that they use a small amount of credit right now, they end into default, and then they use the entire amount and they directly then enter into default. So he is a low credit appetite borrower, or apparently he is a low credit appetite borrower. Now, given that and this will hold true if he has been making his payments appropriately up to date. Similarly, utilization. Now, utilization tells me again about how much a person utilizes his card, right? What is his tendencies of utilizing his credit, or what exactly are his credit appetite. Again, it gives us an idea about the credit appetite of the borrower. However, higher utilization need not always mean that the borrower is more risky. What it essentially means is that given everything else remaining unchanged between two borrowers, the borrower one with a higher utilization is always more riskier. So only by using headroom and utilization, we cannot always identify that whether the borrower is more risky or not, right? So over here, from the utilization perspective, what we generally get to see is, or what we generally so what we generally like get to see over here is that people with, so everything else remaining unchanged between two borrowers, right? The one with the higher utilization is considered to be more risky since he has a greater amount with him, right? So he has a greater on balance sheet amount exposed at his end. So that is the entire, so that's the basic idea. So this again gives us an idea about the credit appetite of the borrower. So therefore, headroom and utilization, or any of its variants or transformation, can give us important insights into the utilization and into the so utilization into the overall behaviors, right? So the headroom, the utilization, and everything. So you have this entire structure. So by looking into the headroom and the utilization, you can say that okay, this guy has a high appetite or not. Now, he may be a good borrower. That does not mean that he's a bad borrower, but what it essentially means is that he's kind of someone who has, or so like he's kind of someone who has a higher credit appetite or a low credit appetite, or who is inactive, or who is very active, and so on. And also by looking into the changing trends of utilization over a period of time, you can make out whether the borrower is undergoing a sudden flip in the utilization behavior or not. So that is another important part that you have, or that you can do. So that's one. Now the next question that comes out over here is that, so one thing that we can say that given everything else remaining unchanged, an account with a lower headroom and a higher, or a higher utilization is considered to be more riskier. So that means it is not only in solidarity with headroom and utilization you can say whether he's the risky borrower or not. So there are other fields that you need to look into, right? So there are other important components as well for credit cards to be looked into, and that is what we need to understand. So the next important component that we have over here is nothing but the payments. So how it so it is not only about utilization which you know defines the riskiness associated with the borrower. It is also the it is also the payment patterns which decides like how exactly is it that a borrower should behave. So over here what we have is the payment behavior. Okay. Okay. So the next part that we are talking about over here is the payments. So basically, what is important is to understand the payments. So when I say the payments made every cycle, so this is payments per cycle. Next is the payments per cycle. Now, when I talk about the payments per cycle, now again over here, payments the way or the payment patterns of the individual is again going to give us an insight into the riskiness of the borrower, right? And when you combine these to the limit balance and the payments together, you kind of clearly distinguish between the riskiness associated with the borrowers, and you can kind of create an idea about exactly how is it that a borrower is going to the payments the payment being made to the payments per cycle which is being made to the borrower, as well as what you also get to see is you get to see how exactly is it that this borrower is kind of working, or how exactly is it that this borrower's riskiness will differ from the others. So you can actually punch in the two together to get the final output, right? So now over here, when I talk about the payments made per cycle, now there are two possibilities. One is that a full cycle payment is done, right? So there is a person who makes complete cycle payments. A complete cycle payments. Right, so this is one. The next that I have over here is the concept of the minimum payments. The minimum payments. Now, people who do the full cycle payment, right, who completely pays it off, are the ones whom we call the transactors. Evidently, evidently, these are people who are paying back 100% of whatever they have used. Now, even if his headroom is very low in the last cycle, I know that this guy is going to pay it back at the end of the cycle. So once the cycle, the payment date begins, within that period, he's just going to pay back whatever he has, right? So that is where the minimum payments will, that's where he becomes a transactor. So this is a transactor, a transactor. The second set of people that we have over here are the revolvers. Now, these are the people who pay back the minimum due, right? They are the ones who pay back the minimum due, and when they have paid back the minimum due, they revolve on the rest amount, or they pay a slightly amount which is more than the revolver. I mean more than the minimum payment, and but not the entire payment, and revolve on the next, and they keep on using their cards. Now, a revolver customer or borrower who is a revolver from a capital perspective is always more risky than a transactor. So the probability of a revolver to default will always be higher compared to that of the transactor, right? So this is one of the most important. This is the very basic observation that we have. But from the business perspective, the revolvers are always more preferred. I mean, non-delinquent revolving base is always most preferred when they are kind of so the revolver base is preferred because you know they because you cannot actually pay back, or I mean you can actually extract the business from these revolvers. So from the revolver is your potential business base, right? So for the transactors, you don't make too much of money apart from consistent fees or something. So you have to find out a different way of identifying them. But from the revolvers, you are always making a certain, or you are always making a certain business, right? You are always getting a certain business, but at the end of the day, when it comes to exposure and capital provisioning, your revolvers are always relatively more riskier than your transactors. Now, one thing is that transactor, so if an account is a transactor, has been a transactor throughout, is someone who has never been delinquent. So a transactor account can never be a delinquent account. However, a revolver account can always be a delinquent account. And this is where, you can again split the business base into, or this so this minimum payment into, or you can split the riskiness over here into two ways. So for a revolver you can have a delinquent revolver and a non-delinquent revolver. Now a delinquent revolver is always more riskier than a non-delinquent revolver, because an account who has never been delinquent and keeps on paying his money but revolves is, it's safe business, right? But always meaning that in times of downturn, or in times of, or in tough times, this account can obviously undergo deterioration and they can end up with kind of a fuss. So over here, so while I talk about this, the revolver payment, the transactor or the revolver, as I say over here, is something that needs to be taken care of. So based on the minimum payment, so let's say, and if there is if an amount who makes a positive payment but is paying less than the minimum amount, then that account becomes a delinquent amount. So an amount who is not paying, who is paying an amount, who is not paying anything, or paying an amount which is less than the minimum payment, is identified as a delinquent amount account in the books of the bank for that particular cycle. So the revolver base can have two types of borrowers, right? So based on the minimum payments, now one is that payment can be zero. The second is that the payment can be less than the minimum payment. And this payment over here greater than equal to the minimum payment. Now, these two bases of records, these two bases of records together would comprise of the delinquent base. All right, so here the delinquent base. The next thing that we have over here is this base is your non-delinquent base. So obviously, when you look into the payment pattern, so therefore one of the important objectives over here is, or one of the important observation over here is, that if you want to assess between the payments, right? So if you want to assess the payments, the payment patterns, so the payment patterns can give you clear insights into the respective riskiness of the borrower. So a transactor and a non-delinquent revolver base become non-delinquent base. So obviously the non-delinquent base as on a snapshot will always be more riskier, less riskier than the delinquent base, right? So this Now, out of these two, there is a third set of risk. Now, not all payment equal to zero are your delinquent accounts. Now, there can be a case where a borrower has been an inactive borrower, right? So the second part, so this is where your balance becomes important. So if the balance of a borrower has been zero throughout for the last, let's say, 6 months or five, for more than a quarter or so, we say that that borrower has been inactive. Let's say for the last 6 months he has made no transaction at all. Then he is someone who is, or so he would be someone who is like, you know, uh, so he would be someone who is, what should I say? So who is like inactive borrower, right? So obviously, one thing you can see is that based on this payment and on the card usage pattern, you can actually distinguish the risk between the borrowers, right? So for this, for distinguishing this riskiness, you don't need to use a statistical decision tree. So obviously, this is one of the levels of segmentation that we talk about, which is going to be the risk-based segmentation. So one thing you can see clearly is that delinquency, right? Card usage patterns, delinquencies, and the nature of the borrowers do help us distinguish the risk across the accounts, right? So similarly, one of the important things that we generally get to see is that so one of the important, one of the other important things that we also get to see is that when segments are being built, right, not necessarily it should be that it's a statistical segmentation. It could be others as well. So there could be different layers of segmentation. So when we develop this model, right, when we develop this segmentation driven model over here, we will see that uh, there are multiple layers of segmentation, right? So one of the segmentation layer will be a regulatory segmentation. So we'll see one of the layers of segmentation being the regulatory segmentation. A regulatory segmentation. Segmentation. The second level of segmentation that we would talk about is the risk-based segmentation. So like using delinquent, non-delinquent, inactive segments to this layer of the initial set of risk, or certain or some other intuitive or other risk level segmentations. So risk-based segmentation is the second one. And the third level of segmentation that we'll talk about is the statistical segmentation. Right? This is where we will talk about statistical segmentation. And this is where we'll separately talk about decision tree and how to and what are the steps of developing a decision tree and what are the challenges associated with a decision tree. So statistical segmentation will call for the development of a decision tree. So how is it that a decision tree actually splits the value, or actually splits, or at what level does the split happen, what are the formulas and everything? So that is where we talk about the concept of decision trees, the decision tree algorithm. We'll talk about the biasness, overfitting, and so on. And from there, we'll talk about how it helps us in building segments. right? So that's how we would kind of go forward, right? Now this has been done. Now over here, what we have talked about are the three basic components of this riskiness, right? So we talked about limit, we have talked about balance, and we have talked about payments. Now, apart from this, there are other a few important. So there are so the patterns of purchases, right, or the usage that you do on the card, right? So the balances, the utilization that happens over here. So one very important part of this utilization is how exactly is this utilization happening? What are the sources of this utilization? So based on that, again, the relative riskinesses can be decided, or you can kind of decide on more riskinesses. So whether the utilization comes solely from purchases, or it solely comes from, or it comes from your so whether it comes solely from the purchases, or it comes from the cash advanced cash withdrawals as well. Now accounts with cash withdrawals, are they more risky than accounts without cash withdrawals? So how does this happen? What are the stages through which this model is or this model can get built, and so on? So these are some of the questions that we will be talking about in the discussion, right? So so the next step over here will be to create out the list of the steps of developing this model, right? So let's take a pause here for the day. I'm not really feeling well, so let's start the discussion from tomorrow. So tomorrow what we will do is we'll start off with the first by laying down the key steps of development. So we have already done that. We've already talked about the key steps, right? We have already seen how the quality checks and all these things are done. So we'll not kind of go into those, but we'll kind of list out a short steps of summary, right? And what are the steps that we need to follow when we talk about the model development exercise. And then we'll talk about how to prepare the data, right? And from there, what are the checks that we do on the data, and how is it that the segmentation model would actually work, not only for the PD model, but for the LGD and the EAD model as well, right? So let's start with this discussion in tomorrow's session. So we have today talked about the Basel framework and the product and the key characteristics of the product, the basic logics of segmentation. And tomorrow's discussion, we will be focusing more on the data preparation, the model design, and the step by step development of the models. Thank you.